I'm Ronnie Eldridge. Welcome to Eldridge and Company. I took a deep breath before reading this book because the subject seemed so overwhelming. But Les Leopold's book, The Looting of America, has made me feel almost like an expert. Now I know it wasn't the people who bought houses that they couldn't afford who caused the crisis. The rest of the title is called How Wall Street's Game of Fantasy Finance Destroyed Our Jobs, Pensions, and Prosperity. And that tells the story. Welcome, Les. Thank you.
Thank you. Thanks so much for having me.
It's a great book. I mean, I really feel a little bit that I understand it. I know who's caused this whole problem. So let's start. It's Wall Street. But what's the difference? What happened since the 70s that's caused all this stuff?
Well, let's take it back to World War II. Between World War II and the mid-1970s, productivity, which is the output per worker hour, it grew remarkably in the World War II period, and wages of the average working person rose exactly with productivity, the same percentages year in and year out. And that was the story behind the great success of American capitalism. That's what made working people be able to improve their lives year after year after year. Well, something very strange happened by the mid-70s for lots of reasons, but that's the beginning of globalization. There's a decline of unions, the deregulation is starting, and for the first time, wages decouple from productivity. Productivity continues to climb to this day. Wages went flat and down. And the gap between those two lines is real money. It has to go somewhere. It's a huge amount of money. And what it did is it started to go to the top. There's one, and it accelerates. The first big push started during the Reagan administration where they unleashed.
They did all this deregulation?
And also, the change in the tax structure. I did a little study.
What did they gave more benefits to the upper?
Yeah.
A lot of benefits.
A lot of benefits.
So it allowed them to keep more money.
During the 80s, the wealth, the net worth of the top 1% went up.
How many? 400?
No, 1%. No, it's more. Went up $1.4 trillion. The bottom 20% went down $256 billion. Now catch this: the
Trillion
debt
versus
billion. The debt of the United States went up almost exactly the same amount as the money that went to the super rich. So there was a huge pile of money going to the top, and wages were staying flat. And this led to two phenomena at the same time. One was that the wealthy, they buy a lot of things and they want to invest their money, right? It's a lot more fun to live off your interest than to spend your capital, of course. So they looked for investments. Well, there were a finite number of investments around the globe that were sufficiently safe to absorb this investment. They ran out of investments. The money became what we call surplus capital. There weren't enough good places to invest it. Now, Wall Street, yes?
Does that have to do also with this country losing its manufacturing? Or
well, I think there's some very intricate connections between the two, but I think if you look
that
at,
we'll go into after we've discovered what we. Okay.
Let's look at the two big trends. So the money goes to the top, and it has a lot of it has no place to go. And people started referring to it as this wall of money. Now, Wall Street's very smart about finding pockets of money and then luring that money into their investment banks and doing something with it. Well, they came up with some very ingenious ideas, and one of them is called these derivatives, where they could create new securities where you didn't have to own anything. You could just okay.
Let me just ask you a question. The Wall Street firms, the investment companies, took that money.
Yes.
And they paid interest.
Correct.
On the money they held to the person who had the money originally.
Right.
But what did they do with the money? Where did they invest the money?
What they did was, first what they did was they recycled the money into high-risk loans.
So that's how we
that's the start of it. That's how you get the subprime market, because they saw that this market was being not served by federal programs, the federal guaranteed programs, and they saw that people were going to pay a higher interest rate. So they made the money available there, and credit cards and auto loans. And a very interesting phenomenon happened. The average person in America's debt to income ratio used to be about 60 cents on a dollar. And as this process happened, it jumped to $1.20 per dollar. So people got more and more and more in debt.
And along with it was a housing boom.
That's what made the housing boom.
Oh, I see.
What made the housing boom was this, they wanted more and more of these mortgages because
so they gave more mortgages.
Because they could sell.
And they could sell houses as more people were buying, so they could build new houses and sell them at more, or you could sell your house, right?
But the real trick behind this was the investment houses wanted those mortgages so they could create these new securities, because there was this huge global market for these securities, because they paid a little bit more than your standard corporate bond or than your federal bond. And since there was all this money that was looking for a home for investments, Wall Street created the investments. After a while, they even stopped using mortgages directly. They made bets on mortgages. So they sold the mortgage. One way to view this is like, how many times can you sell the Brooklyn Bridge? They chopped up the mortgages into securities and sold them one time. Then they sold insurance on those mortgages, sold them again.
Did the same people do that?
Yes. The same investment houses?
Yeah.
Oh, yeah.
They sold the insurance.
Sure. AIG
was an insurance company originally.
Right, but they were the biggest insurer of risky securities. They're the ones that made it possible for them to create layer after layer of these other securities, because they were so risky. People said, well, if I can get some insurance for it, I'll be fine. So AIG had this unbelievable business because they insured all these risky new, what I call fantasy finance securities, because you didn't own anything real.
Right.
You didn't even own the underlying mortgage. You just owned something that referenced it. And then you owned something that referenced that. AIG, now think about it from AIG's point of view. They wrote insurance policies, and because they were considered AAA rated company, they didn't have to put up any collateral. So they got insurance premiums. By the way, you can't call this insurance because otherwise it would be regulated. You call it credit default swaps.
That's right.
That's the word you have to use. Then you sound fancy. So they issued these insurance policies. They got revenues without having to put up collateral. Think about it from their point of view. They're putting up nothing and they're getting revenues. They insured $450 billion of basically junk securities. Now, as long as mortgages, if you have any listeners, and you might not, who play fantasy sports, that's the easiest way to understand this. Fantasy sports is where you basically own teams of baseball players or football players, but you don't really own them. They don't know you own them. You don't pay them.
It's a real team.
It's a real.
You've decided
right.
You own.
Yes. But you have a fantasy baseball team,
right.
And you decided and it keeps track of real baseball players. Thousands of people can play this game using the same real baseball players. The real baseball players aren't really owned by you. They just do they're owned by Major League.
Can you buy and sell the contracts?
Sure. You
with
can
other
buy
people. You can
yes.
move all these real players around.
Right, on your fantasy baseball team. Well, this all works great as long as the major leagues are playing. What if they go on strike? If they go on strike, all the fantasy baseball teams, and there are thousands and thousands of leagues, are worthless. They can't do anything. You can't play the game. Well, once the underlying housing prices stopped going up, and they were going up at such an accelerated rate, higher than any time in American history, ever. So they couldn't possibly keep going up. You couldn't possibly get the debt past $1.20 per dollar. At a certain point, people can't service their debt. So the prices were going to level out. Once they started leveling out and going down, all these securities built on top of them started to lose value. It was as if the major leagues went on strike. Now these fantasy finance instruments became virtually worthless as the prices started going down.
And they tried to sell them or not? Who was going to buy them?
Here's what they tried to do. They tried to collect on their insurance policies from AIG. So all of a sudden they were asking for
Give me my money back.
Well, AIG ran out of this in September.
Did they insure them that the price would not go down? Is that what AIG insured them?
They insured them against default.
Default.
So once the
as the default started.
as the default of the security, at a certain point, the security starts to.
It's at the top of the.
Well, they're different.
In the books, you use wine glasses.
Right. Well, you have
and
to.
you say you have a lot of wine glasses. You pour them, right?
You have to sound sophisticated here. You have to use the word tranche.
Tranche. I
there
love
you
that
go.
word.
So
I
now,
was going to ask you about tranche.
Well, when a certain tranche at a certain point loses enough value, the money gets claimed by the person who insured
It's at the top.
or who took insurance in.
Yeah.
Right. Well, let's start from the bottom. The riskiest ones went under first.
Yeah.
You want to do the wine glasses?
Sure.
Okay.
Yeah.
Anyway, it's like
yeah,
you take a whole bunch. You take a whole bunch of. This is how the securities work. You take a whole bunch of payments from subprime mortgages, put them in a wine bottle. Imagine 3 rows of glasses, like an upside-down pyramid, wine glasses. The top row gets whatever payments you get from this pool of mortgages. They get it first.
So you fill up the glasses evenly.
Right. Starting from the top.
Until they're filled.
Until they're filled. Then what's left over is the next row. What's left over is the bottom row. Well, obviously the bottom row is a lot more risky. So that's the first one when housing prices started to tank and people started to lose their homes and not make payments. The revenues you got in your wine bottle went down. The top people still got paid, but the bottom people started to lose money and they were insured. So they went to AIG and said, please make us whole. Well, so many went to AIG that they ran out of money. And then the next thing they knew was they lost their AAA rating. And then they had to put up collateral. They didn't have it. They didn't have the money. They didn't have the collateral, and they were about to fold. If they folded, virtually every major bank in the world would have suffered, and probably half of them would have gone under. It would have been like a global bank run overnight. That's why the government stepped in. It was because all these other people that owned either the top tranche, the mezzanine tranche, or the bottom tranche, lots of them took insurance. And when the bottom one failed, it made the next one less valuable. When the mezzanine started to fail, it made the ones on top less valuable.
Did the investment houses take some of them in bunches? Not only did they cut them up, but
they kept them. Yeah.
Okay.
Here's where it gets interesting.
We have so much to talk about.
The real money for this, the real money that comes from this is when you make them and sell them. The fees that were embedded in the fantasy finance game, right? You had all this money from all over the world that should have gone to working people that instead ended up in Wall Street. That money was racing after these securities, and because the return looked really good, the fees were good. So if you sold, for example, I know of one case where they sold Royal Bank of Canada sold $200 million worth of this. They made $12 million as a fee up front. That's 5.5%. Pretty good right off the top. Mm-hmm. Now they should have gotten rid of all this stuff, but some of them said, well, you know what?
Let's tranche.
Let's keep the tranche.
Keep it.
Because we're getting such a high return. Yeah. The bottom tranche is getting which they then refer to it as toxic waste. We'll keep some of the toxic waste. We'll insure it with AIG, and we'll get we'll get a 15% return. We'll pay maybe 2% to AIG. We'll still get 13%. Makes our it's now a secure asset on our books. It looks great, and we're in beautiful shape.
So the people selling it made a lot of money.
Huge.
And are they the real culprits? But they're as guilty as the people who bought them. Well, I mean, the people who bought them, it's like Madoff, isn't it? They bought it because they were getting such a...
I think if we want to start talking about blame, we have to be systemic. This is a systemic crisis. It's not like one person, good or bad, did anything. The problem was the fundamental policy that transferred wealth from working people to the super rich. That is an unsustainable policy. We now have a real live experiment. What happens when here's the theory. You take money from middle and lower income people, or let's do it this way. You remove taxes on the super rich. They take their money, they invest it, it creates more factories, more jobs, more new industries, internet, blah, 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 blah. New medical products, and that's how the world booms. And then people get jobs and their incomes go up. We deregulated, we did everything you're supposed to do. It didn't happen. What happened instead was, yes, you got some new investment. They ran out of investment. They got into fantasy finance investments. The average working person's salary actually went down since the mid-1970s in real terms after inflation. You have this enormous accumulation of wealth at the top, and the system crashed. It's not like some lefty saying, oh, it's going to crash someday. It crashed right before our very eyes, and we went right to the edge of another Great Depression. And it's only by luck so far that it hasn't happened.
It wasn't only Reagan who deregulated. I mean,
oh, no, it started with Carter.
Yeah.
It actually started with Nixon.
And then it's gone right along, hasn't it?
There was a fight. The New Deal controls are good for the economy or whether you should unleash the economy. And that fight went on, and finally in the 70s and 80s, the free market ideologues won the fight. And they got a chance to test their theory right in front of us all. And we just lived through it, and it created fabulous wealth for the people at the top and then crashed the system. And I don't think that's in dispute.
No,
I'll take anybody on that.
Why do people, well, we talked about this before, why people need so much money, but let's go beyond that. So it is this motivation of making more and more money. I mean, what does that say about our culture and society?
Frankly, I don't think greed has ever been eradicated in society. View this more as a balance of forces. When labor unions were strong, when there was a culture of public service.
Right, all of that.
Look, in the 60s, we did a number on the idea. I mean, you saw the movie The Graduate.
Right.
It was a joke, to be involved in industry, to make plastics. You know, making money was not number one on the list of people who were coming into the world in the late 50s and 60s. The idea was to build a better world, have a satisfying career, public service. But greed was always there, but it was contained by these New Deal controls and regulations and by the strength of public power, largely in the shape of the civil rights movement and in the shape of the trade union movement. Well, the unions lost, and also, you know, there were controls on international trade, severe controls on money flows until Bretton Woods fell apart.
So, are we going to continue now after we're bailing everybody out? We're being told that we can't cap salaries because we'll lose all the brilliant minds in Wall Street that seemed to me were the ones who created this whole mess. Are we going to still have credit default swaps, for instance?
Well, there's a fight going on right now. First of all, the Wall Street's saying, if you screw around with us, you're gonna kill innovation. And I'm sitting there saying, go ahead, screw around with them, because I'm a Luddite, a financial Luddite now. I'm having trouble finding out what are these great new financial innovations. They make it sound like it's the latest iPod, or it's the latest new biotech marvel. The mortgage was created, 1,200 years ago or something like that, and it was the New Deal, the government, that created the 20 and 30-year mortgage. The adjustable mortgage, which is supposed to be a great new innovation, well, ask yourself a question of how well.
That's so good. It wasn't very good.
It seems to me finance. I divide the world into two basic economic sectors: the goods and service industries. Seem to run very well in a market fashion. Yes, there needs to be controls and product safety and whatnot, but they run pretty well. The financial sector, when you run it like a deregulated free market, two things happen. One is the institutions get so big that you can't possibly let them fail, like AIG, because they'll take the whole world with them.
Right.
And secondly, they can suck these huge amounts of money into the sector.
Pay them. Been going into.
Yeah, and it's very hard to stop once it's deregulated. So there's two things that have to happen. We have to move money as best we can from the financial sector into the real economy, and the best way to do that is go ahead, put those caps on. If you're going to give money to them,
and raise their taxes.
Steeply, go back to the 1950s, where once you start making over $2 or $3 million a year, boy, you start paying 60, 70, 80% of the next dollar. Steeply progressive income taxes. So one is move money from finance to the real economy. The other is move it from the top to the middle and the bottom, because it's so destabilizing. We've tried it. We don't need another. We did it in the 1920s, and we did it again. You don't need a third experiment in deregulated finance. It does not work.
When all of these economists look back to the Depression, What is it that they say?
Oh, there's an argument about what they say. The Bernankes think the Depression was really caused by bad Fed and governmental policy, Federal Reserve policies that tightened the money supply and turned, a little crash into a huge disaster. Others, like Keynes and this guy Hyman Minsky, say no. There's a fundamental problem with the way finance works, and left on its own devices, it will blow up. And Keynes, in fact, occasionally advocated socialization of the financial sector, and we're about halfway there right now. I mean, many of these banks could not operate at all were it not for the federal government. They'd be gone.
Do you think that basic to this is, I think you referred to it, and it was something that I loved, because in the government I've always found, if you're rich, you must be smart. I think you talk about something similar to that.
Well,
do we let these people, I mean, does this go back, way back to
I'll tell you a story.
Kings of England and people, this royal sense? What is it?
It's very funny. I just was a lot of my knowledge comes from soccer dads in my town who work in finance. So I was at a soccer barbecue last weekend, and one of the guys was talking to me, and he's convinced that the top guys at Morgan Stanley and J.P. Morgan are so smart that they engineered this whole thing.
Oh, I see.
That they figured out how to make money up, and then they pulled out, and then it all crashed, and they make their money going down, and now they're going in to make their money again. And that it was all by design. And I'm sitting there thinking, you know what? Nobody's that smart.
Right.
I know a lot of the folks that in my town that work in finance. They're very bright. You're very bright.
You're very bright.
There are a lot of very bright people here, and they know their area, whether it be mergers and acquisitions and manufacturing, or whether it be structured finance. They know it. I mean, they really know it. But when they start, I listen very carefully. When they start talking about the economy as a whole or Fed policy, you know what? They sound very much like everybody else. Their expertise is constrained. So yes, they're smart. There are a lot of smart people. I wish a lot of these folks that were in finance would bring their smartness to medicine, engineering, and education,
and the government.
And the government, where we so desperately need help.
Yeah.
But the money is attracted to them.
Then they do that by their largesse, so they have hospitals named after them and things like that.
Right. Well, that's true. Also, that kind of bugs me when that happens.
I know. It just is too much.
Seems like, but it doesn't work. I mean, look, if we were sitting here in the middle of a boom, I wouldn't be on this show. I wouldn't have been able to write this book. And if I talked like this, you'd be dragging me out of the room as a lunatic. But the system crashed right before our very eyes. We have a right to talk about why.
So what should we do about it now?
Well, the two things the framework for this is move money from the top of the income scale to the middle and the bottom.
Which is what the president has said
he's
he'd
trying,
like to do.
Yes, and move money from the financial sector into the real economy. And the best way to do that is if you dampen the wages, you take the incentive out of being, all the graduates from the Ivy League schools that are rushing into finance will go, oh, wait a second, maybe I shouldn't do that. It's wage control is not a good place to work. I won't be able to, create all these new derivatives and make, millions of dollars.
All these bonuses.
I won't get all the bonuses. So that would go a long way.
Do you think there's a chance that they'll be able to do with that cap?
Well,
is the outrage enough? I mean, it's very hard to tell. Is there still this? Are we still in this crisis? You read now that the investment banks are going to, or the banks, whatever it is, are going to pay their money back, so they won't be under any regulations. That this is going on, that's going on.
It's funny. I always have kind of two emotions about this. For the people who are, losing their jobs or almost losing their jobs, all of us are praying that this thing will come together and that somehow we avert a disaster. But the world is a very, very complicated place, and it's so interrelated economically now. It wouldn't take much.
You can't just patch it back together.
I mean, what if this swine flu had turned out to be a big deal, and it interfered with economic production? This little bit of an upswing could go right off the cliff again. The financial system is incredibly unstable. You can't operate a global economy the way we're operating it right now, and everybody involved knows that. So they're trying to figure out how to patch it, whether they see, you know.
So we as a public, should we be pressuring our representatives in Washington for a certain thing? What should we be doing?
Absolutely.
What should we say?
Well, I
what
think
do I say to Barney Frank?
Go for the wage cap. The first thing to tell Barney is say, don't fall for this innovation argument. You're not talking to the heads of Apple. You're not talking to, you know, the great
Really
biotech companies.
Yeah,
You're talking.
Different creative.
Ask them to show you what. I want a list of the financial innovations in the last 10 years. What are they? And 90% of them are harmful. You have to show that an innovation produces not just a profit. I want
For you, right?
Yeah, that it's socially useful. And here's what I mean by that. Profits are a very funny thing in the financial sector. Between 2005 and just before, let's say, 2007, the New York Times reported that the 9 largest banks and investment houses earned $300 billion. Now, half of that went out in terms of wages and bonuses, right? That's how they usually do it. $305 billion. Since then, they've lost more than that. Those same 9 institutions lost more than that. It's gone. It's in the red. Our TARP money is making up the difference. Well, what happened to the first $300 billion? That's sitting where? Where's that money right now? That's gone.
Yeah.
It's sitting in somebody's account somewhere.
Right.
Maybe they've lost value on their investments. Maybe they didn't.
Yeah.
But that money is gone.
Taken out. It's just eliminated.
We need to have the cap, move that money into the real economy, discourage, and just tell Barney, prove it to me that these are innovations. I want to see that they were positive social innovations, because I don't believe it.
Thank you. We're at the end.
Oh.
So now, the book, it's not filled with all kinds of technical things at all. You're going to get more of what Les has just said, right? I mean, definitely.
It's not technical at all.
But also, you're now writing a blog on Huffington Post.
Yeah,
right?
fear and looting in America.
So you'll be able to keep reading more things, and believe me, it's great and it's entertaining, but it's so important to really understand what you're doing. So look for this book, look for the blog, and thank you so much, Les.
Thank you very much.
If there are any people you'd like to hear and topics you'd like us to explore, please let me know. You can write to me at CUNY TV, 365 Fifth Avenue, New York, New York, 10016, or you can go to the website at cuny.tv and click on Contact Us. I look forward to hearing from you.